Hey everyone, I'm Ishan Sharma. In this video, I want to talk about investing, a complete step-by-step tutorial for you to understand the basics of investing. What is a stock market? How can you start picking stocks? How can you buy a stock? How can you choose a broker? We will also be covering topics like fundamental analysis and technical analysis. So make sure that you watch till the end and we will talk about all of these things. The timestamps are given in the description so you can take a look at that if you're interested. But now let's get started with this video. The first question people will ask is, what is a stock? Well, stock is just a piece of a business, a publicly traded business. I'll give you an example. So I have a business, Marketup Media Private Limited. It has about 10,000 shares, which is equally split between me and my co-founder, about 5,000 shares each. And that is basically what we have. Now you cannot trade shares of Marketup because it is a privately held company. Then you have publicly listed companies. Let's take a look at who are the different participants in this stock market. Number one, you have normal retail investors like you and me. These are people who are having an intention to buy or sell a share. Then you have the brokers. Brokers are platforms which make sure that you have actually sold a share at a particular price and that share is actually available in the stock market to be bought or to be sold. Then you have the clearing corporation. The clearing corporation makes sure that your trade, the transfer of shares from one account to another account gets executed, and then these shares are exchanged or are sent to the depository. Depository is just like a digital place you can imagine where all of your Demat accounts are stored, and that is where all of your shares get deposited, right? Whenever you want to participate in the stock market, you do so with the help of a Demat account. Demat account is similar to your bank account, but in this case, you would be holding shares instead of money. Now you have two major stock exchanges in India. Number one is NSE, then you have BSE, National Stock Exchange, and Bombay Stock Exchange. There are about 5,000 or so companies listed on the Bombay Stock Exchange and about 2,000 on the NSE. Now, companies that are listed in these stock exchanges can be divided based upon the total market capitalization of these companies. First of all, you have companies that are large cap companies. These are companies that have a market capitalization of more than 20,000 crore rupees. All right. Now, what is a market capitalization? Well, basically the total number of shares multiplied by the value of each share at that particular date and time. And that is how you get to the market capitalization of a particular company. Then you have the mid-cap companies. These are the ones that have a market capitalization of between 5,000 crore rupees and 20,000 crore rupees. At the end, you have small cap companies. These are companies that have a market capitalization less than 5,000 crore rupees. So that is basically how can you divide them based upon their market capitalization. The next thing is going to be depending on the different sectors that these companies are a part of, right? So you can have FMCG companies, you can have banks, you can have financial service companies, and there are various other sectors that you can divide the complete market into. Now you might be thinking, why does the price of a stock keeps going up and down on its own? Like, how does it fluctuate exactly? So the basic idea behind that is price discovery. Whenever you have a stock or an asset trading, and you have various different people that are participating in a stock market, all of us can put different values on that stock. Let's just say that the current price of a stock is 210 rupees. You can just say that, no, the price is going to be 211. Someone can say, no, the price is 209. So this is called as price discovery. It depends on the demand and supply of a particular stock, and that is what you need to understand about how does a price fluctuate, right? It works on the basic idea of demand and supply. When the demand is a lot more and supply is limited, the price will obviously go up. When the demand is low and the supply is a lot in the market of a particular share, the value will automatically plummet for that particular stock. So that is the basic idea behind stock fluctuations in prices. The next question that you might be thinking is, how do you buy a share, right? So as I have talked about previously, you need to choose a broker. How do you choose a broker particularly in India? Well, I personally have used 3 different brokers. I have used Groww, I have used Upstock, and I have also used Zerodha. I'll show you all of them, and I will also talk about how can you compare different stock brokers. Different brokers might have different fees, and then depending on that, you can choose which one is more suitable for you as an investor or as a trader. Also, you need to define yourself. Who are you? Are you an investor in the stock market or are you a trader in the stock market? Never be a speculator. Never be one of those people who are listening on gossips or who are listening to stock tips on CNBC during their trading hours and then deciding what stock to buy, what to sell, because everyone will be looking at those stock tips. When you look at what everyone else is doing, then you will obviously lose, because when everyone does the same thing, when everyone wants to buy, the price will go too high. And then if you buy at that point, then of course you might have a higher chance of losing money on that particular day. Do not follow the herd mentality. Always make sure that you have a system in place because of which you can define what stock to buy, what stock to sell, why to sell, when to sell, and how long should you be holding that particular stock. And that can be done with the help of either fundamental analysis or technical analysis. We will talk about those in some time in this video. Now let's try to compare the different brokers that are available to you to start investing, right? So I recently found this really useful website which is completely free to use. It's called as select.finology.in, created by Pranjal Kamra, who is a fellow YouTube creator. So I'll show you exactly how that works. So this is select.finology.in. You can basically just go to brokers and you can find all the major brokers in India and how much do they charge, what are their fees. Now they have various types of fees. First of all, they can charge you whenever you want to open a Demat account with them. They can charge you for maintenance charges. They can also have fees for whenever you buy a stock on their platform. That would be done through either delivery or through intraday. We will talk about that in some time. And then they also have some other charges that we will be covering in some time. Okay, so that's basically how that works. You have Upstocks, you have Zerodha. That is what I have also used. Now you can take a look at the full details of this particular stockbroker, and you can see how much fees do they charge for various different activities that you will be doing on the platform. You can also visit their calculator to see exactly how much do they charge. So I'll just click on this. Let's just say I want to go to Zerodha, and I can see how much they charge for about 100 shares, which each have a price of 1,000 rupees. So this is about 1 lakh rupees that I'm investing. You can see exactly how much will they be charging you if you want to do intraday, if you want to do delivery, if you want to do futures, or if you want to do options, right? So all of that is available right in front of you. What is delivery? Delivery is normally what you would do if you want to do long-term investing or if you want to not do day trading. Now intraday is a type of an order which you need to square off on that same day itself, right? So it's called as MIS. Basically you would buy that stock and then you would sell it on that same day. You can also sell that stock and then buy it afterwards, which is called as shorting. We will look at that in some time. Every single order gets executed in 2 days, right? So it's called as T+2 delivery. Let's just say that you buy a stock on Monday and on the same day you square off your position and you sell it on the same day, and let's say you have about 100 rupees profit. Now that profit will appear in your Demat account in 2 days. So it will be available on the Wednesday of that same week. So that's basically what you should keep in mind when you're looking at delivery and intraday. Then you have futures and options, which we'll be covering in some other video, not in this one, because this is just a beginner tutorial. So you can see exactly what charges will be levied to you when you use this particular broker. Always make sure that you understand this very clearly. You have GST, you have exchange charges, you have STT, you have brokerage applicable and other things over here. Okay, so this is very important for you to keep in mind whenever you're buying or selling a stock. Pick a broker that works for you. Also, the stock market is only active between 9:15 and 3:30. So all of your trades that you need to execute will need to be done on this time frame itself. You cannot wake up in the middle of the night and be like, I want to buy a share. So always keep that one thing in mind. You can do it only on the weekdays, 9:15 to 3:30. Okay. Now let's see how can you buy an actual stock. So I'll give you 2 different examples. We'll be looking at Upstocks as well as Zerodha's Kite to see exactly how can you do that. So it's going to be the same for every other broker as well, but just to give you an example. So first of all, you need to deposit funds from your bank account to this Demat account, and then you can start to buy and sell. So for that, you would need to do funds, and in funds, you can add the funds over here. Once the funds are added, then we can move ahead on the dashboard, and I can now, let's just say I want to buy Infosys. I can click on buy, and then here note what is happening. First of all, I am on the buy tab right here. I can also go to the sell tab if I want to. So I'm on the buy tab right now. You can choose if you want to go with NSE or BSE, and after that I have this regular order. I can decide what quantity do I want. So I only have 10,000 rupees in this Demat account particularly. So I just want to go with, let's just say, 1 quantity. You are looking at 2 things. First of all is intraday. Then you have long term, CNC. This is basically cash and carry. So the way this works is that in long term, you are basically saying that you want to buy it and keep it for the long term. Whereas in intraday, you are basically saying that you will buy it today and you will also sell it today itself. You have to square off your position today itself. So that's what this is all about. You will decide what quantity do you want to buy for this stock. I'm just choosing one for an example. Then you have limit order or market order. So limit price is basically you telling that you want to buy this share at this price itself. You can decide it depending on what you see fit for the price of this stock. Then you have the market order. This is just the current last traded price, also called as LTP for this particular stock that you can see right here, right? 1,918 rupees. So I'll just click on market price. And then as you can see, I cannot choose the price because it will be automatically done. So that's how that works. Then you have something called as stop loss. And then you have stop loss at market price. A stop loss is something that you put up so that you can prevent the losses for that particular trade, right? So let's say that you have one share of Infosys at about 1,915 and you put a stop loss of maybe 1,800. That basically means that whenever the price falls below 1,800 rupees, it will automatically be sold, right? So that is basically what stop loss means. It's good to have a stop loss. Don't just blindly buy a stock and keep it with you forever. And then you will also see something called as GTT, that is good till triggered. In that you basically are saying that you want to buy the stock currently at the current market price. And then you have a stop loss that basically says that at this particular price you want to sell the stock to prevent your losses. And you have a target. Let's just say the current price is 1916 and you are saying that you have a target of 2,000 rupees, for example. So when the price reaches 2,000, it will automatically be sold so that you can protect your losses with the stop loss and then you can also protect your profits, right? So this is something that you can create. It's a system that you can build so that you are protected from both the sides. So that is how that works. I will now just click on buy and ultimately, as you can see, it says completed. Buy in fee is completed, one quantity at 1917.35. Now let's take a look at how do you sell a particular stock without even you owning it. That's called as shorting. So you first of all sell the order, you sell the stock and then you buy it when it is reaching a lower amount. So you bought it at let's say 100 rupees, you sold it at 150 before even buying it. So you made a trade of 50 rupees right there. That's your profit. So that's basically how that works. Just to give you an example, I can go on to ONGC, I can click on sell and I can just go with one quantity. It's going to be intraday and I will click on sell right here. And as you can see, I now have sold an ONGC stock that I don't even own. I can go on to the orders and I can see that this is now completed. So as you can see right here, you have an MIS order of ONGC minus one quantity of shares. This is the average price of that on which I bought it. This is the last traded price. And then I can see my PNL for both of these trades. One more example I'll give you of buying an ETF, which is an exchange traded fund that you can buy directly with the help of your Demat account. So you can just click on buy. The current price is 197. And let's just say that you want to buy 5 of those and you can just click on buy right here. And as you can see, this order is also completed. So you can see this in front of you. So what is Nifty Beast? This is just a ETF, which will basically be tracking the top 50 companies of Nifty, the index itself. The same thing you can do with the help of Upstocks. Now let's just say that you want to buy a share of Reliance with the help of Upstocks. So you can basically just do this, go to Reliance and you can click on buy right here. You can put the quantity. Let's just say the quantity is 1. The product is delivery or intraday. You can decide which one do you want to go with. I'll just go with delivery. Order type is going to be market. You can choose what you want to do. As I've talked about this previously, you can have an SL limit, you can have an SL market, and then you can basically review the buy order and then you can purchase it. Okay, you can also sell it, but this is basically how this works. This is the basics of buying and selling a stock. If you want to sell it, it's very simple. You can just go to whatever Demat account you have. This is my positions. Let's just say that I want to sell this thing. I can click on exit and I can just basically sell Infosys stock right there. And this is how you can easily buy and sell a stock with the help of whatever broker that you have. Now let's take a look at the indexes. So you first of all have Nifty index that is just going to track the top 50 companies as I showed you with the help of that ETF. So you can track the top 50 companies and their performance with the help of this Nifty 50 index, right? There are also other indexes like you have Nifty 100, you have Nifty Air, you have Bank Nifty, you have Fin Nifty. Basically, these are of different categories. You can have Nifty for small cap, you can have Nifty mid cap, and you can also do the same thing with the help of Sensex, right? So that's basically how that works. Now, Nifty 50 is a weighted index. What that means is that the top companies which have a higher market capitalization will have more percentage share in the Nifty 50 index than the lower ones. So always keep that in mind. It's not an equal share. The next thing is going to be the different assets that you have in a stock market. So number one, you have these stocks that you can trade with. I just showed you how to buy, how to sell. The next is going to be ETFs, which are similar to mutual funds, but these can be traded on the stock market itself. For a mutual fund, you need to approach a asset management company and they will issue you a unit of their mutual fund, and that will be done based upon its NAV, net asset value, for that mutual fund unit. So that is the basics of what a mutual fund is. You have an asset management company that manages the portfolio of that particular mutual fund. But ETFs in general are more like stocks, but they're also like mutual fund. It's sort of like a combo of both of them. Now, normally stock markets have given you about a 12 to 15% return annually. I'm talking about the index itself. So if you buy the Nifty 50 index through an ETF, that way you can experience that increment in the whole market. The best part about having these indexes is that you can understand the whole market trend, like where is the market headed. So if I just show you today, as you can see, Nifty has fallen by 0.5% today, right? And Sensex has fallen by 0.3837% at this moment. The next part is going to be about how do you buy a mutual fund. So it's very simple. You can buy it either on Coin, you can buy it on Upstocks as well. You can just go to mutual funds right here and you can start purchasing over here. Or you can also go to Groww, which is what I personally use right now. So over here, you can actually just go to the Explore tab right now. You can pick any mutual fund that you want to invest into. Let's say that we want to invest in Parag Parikh Flexi Cap. And then you can see the performance of this mutual fund over the past year, right? So you can see exactly what type of assets do they invest into. So this is an equity mutual fund. They only deal with equities. These are stocks. Then they have Flexi Cap. Flexi Cap basically means that they are having complete freedom to invest into either large cap, mid cap, or small cap companies. Then you have very high risk. This is basically showing you the risk profile of this particular mutual fund. Also, make sure that you understand what is your risk profile and how much you're willing to lose. And based on that, you should invest in certain assets. Some of them are very much secure and they end up having lower returns, whereas there are other ones which are very high risk, but they also have higher returns, as you can see on your screen. So this one is 31% 3-year annualized return. What that means is that every single year, on an average, this mutual fund has given about 31% increment. So that's how that works. Now this increment is on the NAV price of this mutual fund unit. So as you can see the NAV of this particular mutual fund. Every single day it is going up, it is going down, just like a stock. Now you can invest into these either through an SIP that you can do every single month, or you can also do a one-time lump sum payment. So what happens is, generally, if you are a long-term investor, you would want to do monthly SIPs. These are systematic investment plans in which you are basically saying that every single month on a particular date, you will be putting forth, let's just say 10,000 rupees, 5,000 rupees, 1 lakh rupees, whatever amount it is. You will continuously invest it with complete discipline in this particular fund or in a particular stock, and you will do that for the long term. The best part about doing this is called as dollar cost averaging, in which you are basically securing the ups and downs and you are making sure that your capital appreciates over time properly. So let's just say that on the 1st of February 2020, you invested 50,000 rupees in the stock market through some mutual fund, through some ETF, whatever it is. And that is your lump sum payment. And then you didn't do anything else afterwards. And by the end of March 2020, there was a huge market crash. And because of that, your 50,000 rupees would have been worth a lot less at that point in time. So to avoid all of these things from happening, it's advisable that you do a proper SIP every single month. So as you can see, you can do an SIP amount right here. Let's just say that you want to do SIP of 10,000 rupees, and you can select what date do you want it to happen every single month, and it will automatically deduct from your bank account. So that's how that works. You can start this SIP, or you can also do a one-time lump sum payment. For most of you who have a salary that is coming in continuously every single month, you can pick this SIP thing. It's going to be a great source for you to constantly invest and stay in the market for the long term. There is a very popular quote that goes by time in the market beats timing in the market. So I hope that you're able to understand this. If you have any questions, you can tell me in the comment section. As you can see, I've invested about 4.4 lakh rupees in this mutual fund itself, and I have about a 15% return right here, which is good enough. Then you can go down and you can see the return calculator. If you invest 5,000 rupees per month, then in 3 years, this is how much you would have had: 3,06,000 rupees with about 70% increase in your capital, appreciation of the capital basically. Then you have 5 years. So if you continuously invest 5,000 per month for 5 years, this is how much return you would have in total. This is the total price. So basically you can subtract the, 5 into 12 into 5,000, and then you can get the actual return that you got on that investment. Then let's say that you do a one-time payment, and then you can see how much the capital value has appreciated. Then you have the holdings. Here you can see what stocks or assets do they have in their portfolio, right? So they have Bajaj. As you can see, they also have Google stocks. They invest in ITC, they invest in Microsoft Corporation, Amazon, Facebook, then they invest in Indian Energy Exchange, HCL Technologies, ICICI Bank, and you can also see the percentage of the total portfolio for that particular stock. So that's how that works. They are also investing in foreign equity. That means that you are able to diversify your portfolio both in terms of the companies as well as demographically, right? So some of it is going in Indian companies, some are going into US based companies, and this is why we have seen the good return from this portfolio, from this mutual fund. Then you can see a minimum SIP amount of 1,000 rupees for this mutual fund. At least 1,000 rupees per month you have to start investing if you want to invest in this mutual fund. And you can see the fund size. This is basically the AUM, asset under management, for this mutual fund. So this is going to be 19,933 crore rupees, which is huge. In the next part, you can also see exactly where is that AUM distributed, right? So are they putting it in equity? They are putting it in debt. They are also putting it in cash. They also have about 4.5% cash reserved. Let's say that you want to take all of your money out of that mutual fund, then you can do that because they have this reserve for you. So that's how this works. Then you can also see the equity sector allocation. That basically shows you that in which sector are they mostly investing, right? So you can see 31% is in technology, 28% is in financial companies. Then they have others, they have services, FMCG, automobile, and they also have some ratios like P ratio, PB ratio, alpha, beta. Basically, beta is just showing you how volatile is this mutual fund when compared to the index. The volatility of this index is taken to be 1, then the beta of this mutual fund is 0.72 in comparison with that 1. So I can understand that this is less volatile when compared to the Nifty index. Then you can also see the pros and cons over here, and you can also see the expense ratio. So expense ratio kya hota hai? This is basically the fees that they levy on you for managing your money, for finding out great investment opportunities. Okay, so they have various expenses. Obviously it's a company, it's an asset management company. They have to pay their employees, they have to pay for finding out good opportunities, they have to pay for various other things as well. You can see the expense ratio as 0.82%. Now always keep one thing in mind: actively managed funds like this one will have higher expense ratio when compared with passively managed funds. An example of a passively managed fund could be an index mutual fund. So for an index mutual fund, they don't have to find opportunities, they just have to track the index in general. So I'll show you how that works, but this is basically what the expense ratio is looking like. The exit load is basically what is levied on you when you exit this mutual fund. So as you can see, for units above 10% of the investment, exit load of 2% if redeemed within 365 days. So that means if you redeem within 1 year, then if the investment is more than 10%, then it will be 2%. Okay, the exit load will be 2% of the total investment that you have done, and 1% if redeemed within 365 days, but on or before 730 days. After 730 days, the exit load for this fund will be 0. So that's how that works. Then you have stamp duty, which is general for all mutual funds out there. Then we have tax implications. So basically, when you invest in a stock or into a mutual fund, your capital appreciates. Let's just take for an example that it does appreciate. So let's say that you invest in some fund or a stock, 1 lakh rupees invested. In about 5 years, it is at, let's say, 1,50,000 rupees. So you have a capital gain of 50,000 rupees right there, right? So you are liable to pay depending on the conditions that the government has given to you. So what happens here is that the returns are taxed at 15% if it is redeemed before 1 year, right? So for any mutual fund or for any stock out there, if you redeem it, if you sell it before 365 days, then you have to pay 15% of your returns. But if you sell it 1 year later and the returns are more than 1 lakh rupees, then you have to pay 10%. That is called as long-term capital gains. The previous one was called as short-term capital gains. So always keep this one thing in mind. Also one thing, in short term, it doesn't matter if it is less than 1 lakh as well, you will be taxed. But for long term, your gains will have to be more than 1 lakh rupees for the taxation to happen. So that's how that works. Then as you can see, minimum investment amounts, the fund manager, you can see who is the person who is managing this fund and what credibility do they have. You can also read their documentation to understand more about what this fund does and what is their objective. Some of them might have an objective to get a lot of returns, and then the risk would be subsequently higher. And some of them are just about conservation. So they might have less returns, but would be more stable and would have less risk involved as well. Try to make sure that the expense ratio is less for whatever mutual fund you are choosing, and the returns are also a lot higher. Now, just to give you an example, this is HDFC Index Sensex Direct Plan Growth. You will see direct and regular. So you have direct mutual funds and you also have regular mutual funds. Direct mutual funds are the ones in which you don't have to have a middleman in there and you can directly invest with the AMC. In case of a regular, you will have more fees involved. So always make sure that you avoid that. Always go with direct mutual funds. This fund is just trying to replicate the index itself. So you don't have to worry much about where to invest, where not to invest. And you can also see the expense ratio, 0.2%. The previous one, Parag Parikh, was an actively managed fund. So that had a 0.82% expense ratio. Also, you might have heard that disclosure saying mutual fund investments are subject to market risk. Always make sure that you understand that nothing in the stock market is guaranteed. We all have probabilities of how something will perform in the future. When I say that the stock market has given an average return of 15% or 12%, that is an average return. That doesn't mean that in the next 1 year it will give me a 15% or a 12% return. It is possible that it gives me a lot higher than that. It is also possible that I get a 5% return. It is done on a larger time scale, right? So if I am basically saying that over the past 30 to 40 years, the stock market in India, or you can take an example of the US stock market as well, has generated about 10 to 15% returns on average. It is the average returns. So always make sure that you keep this one thing in mind. You can also see the different types of mutual funds available. So you have debt funds, you have equity funds, you have hybrid, which is a combination of both equity and debt. You can also select on the basis of the risk profile that you have. You can also select based on the AUM, the fund size. So as you can see, these are the most popular mutual funds on this platform, that is Groww. You can also choose the ratings, high to low, returns, high to low. I can do this and I will get the highest return mutual fund. So that is going to be ICICI Prudential Technology Direct Plan Growth. Now I also invested into this long time ago. Yeah, as you can see, right, 39,000. I have a 67% return right there. So this is great. This is a really nice performing mutual fund because it invests into the IT sector, and that is the sector that is booming right now. So in this case, we have 35% returns, 35.93% returns over the past 5 years for this particular mutual fund, which is a lot higher than the 15% index returns that we normally get. But this is for the 5 years. You have to make sure that this is consistently giving you returns over the long term. So as you can see, when I switch to all time, so this is going to be from 2013 to 2022 right now, about 9 years. This has given me 28% annualized returns every single year. This is a good mutual fund that you can look if you are fine with the very high risk and you want to invest into the IT sector. Now, if you go down, you can see the expense ratio for this particular fund, which is going to be higher, which is at 0.76 right here, as you can see, right? So what this means is that it is going to be a lot higher than passively managed index fund. But if it consistently beats the index, then this is a good thing, right? So it's not like any fund that has a higher expense ratio is going to be a bad thing. Also look at the returns that they have, and if they're able to beat the index. This is always a very popular thing that goes on in the market, that you have to beat the index. That's the plan of every active trader or an investor, that you want to beat the stock market. What that means is that you want to beat the benchmark, which is the index, about 12 to 15 returns. If you can get more than this in a complete year, then you have successfully beaten the index. Now, if you look at the long term for about 20 to 30, 40 years, it's very hard to consistently beat the index every single year. You might do it this year, you might do it for 4, 5, 10 years as well, but it's really hard to do it consistently. Warren Buffett has done an amazing job of getting about 22% CAGR, compound annual growth rate, on his investments. And he has done so by cherry picking stocks and by value investing. But there are very rare instances in which you can do something like this. So always make sure that you understand this. Now let's talk about the different investment strategies that you can have, right? So there is no limit to this, but I'm just briefing you over the most common ones. First of all, you have passive investing. In this, you don't really care about what is the company about. You don't care about which stock is going up, which stock is going down. You don't care about when to buy, when to sell. You just decide a date of a month, and consistently every single month you invest in an index fund, and that's all that you need to do. You don't have to put in any of your time or energy thinking about where to invest. And over the long term, this is seen to be one of the best ways for you to invest without putting in much time. The next one is called as active investing. This can be either through long-term investing, or you can be a short-term investing. That could also be a trader. So in long-term investing, what happens is that you use certain method called as fundamental analysis to pick a certain bunch of stocks and you hold on to them over the long period, right? So you don't care about aaj kahan niche ja raha hai, aaj upar ja raha hai. You think about the long term of that particular company and then you take a bet on it. That's what, investors like Warren Buffett has done, and it works. But then you have to be very much cautious and you have to learn the art of finding intrinsic value in companies. There is one more way for you to start investing with the help of small cases. So small case kya hota hai? Small case is not exactly an asset. It's more of a idea or a strategy through which you are investing. So as you can see, invest in ideas with small cases. I have tried small case out. It's a great way for you to invest if you are unclear for where exactly you should be investing. You can click on discover small cases and you can see all the small cases that they have. Depending on what is your aim or what do you want to invest into, you can choose right here. For example, they have this small case called as equity and gold, right? So this is basically one small case that you can invest into, which will then invest your money into ETFs. If you go here, you can see that it is investing into a gold ETF and a Nifty 50 Bees ETF. This is similar to the mutual fund, but the only difference in this is that you can actually see where exactly your money is going, and you can yourself take part in the redistribution. So what happens is that every once in a while they will say that no, we want to change the percentage, or you want to buy this stock, you want to sell this stock, so please do that accordingly. So you can do that with the help of a small case, and you can actually say yes to it or you can say no to it as well if you want to. That is the better part about small cases, and that's what makes it better than a mutual fund. You can find various different strategies, like you have IT tracker, right? This is just tracking the top IT companies. You can see the stocks and weights that they have. This is for IT consulting and other services. Then you have application software. You can see that at least you have to invest with 89,000 rupees. You can also start an SIP in these small cases. So that's what you can do over here with the help of a small case. You can also compare how it performs with respect to the index. So as you can see, this blue line is for the IT tracker and the yellow one is for the index itself. So it has beaten it, as you can see, in the last few years. So that's how that works. So people have a misconception that they will just look at the big shot investors like Rakesh Jhunjhunwala and they will just copy all of their trades, right? Like whatever company they are buying, they will buy it. Whatever company they are selling, they will sell it. This is not a good thing to do, and I will tell you why. So what happens is, whenever you have a big shot investor like Rakesh Jhunjhunwala and they start investing in a company, they don't have to declare it to anyone that they are investing until they get to 1% stake in that company. Once they take 1% stake in that company, they will have to declare it, and that is when everyone else gets to learn about their trade, and then they start to buy that stock. But there's a big problem. They might have been buying that company stock for the past 5 years at very low prices, and only at 1% they need to declare it. Let's assume there is a stock worth 100 rupees. At the time of declaring that they now have a 1% stake, the price is 100 rupees. For example, they've been buying it slowly for the past 5 years consistently, right? So they might be buying it about 20 rupees, 30 rupees, 40 rupees. And only when it reached 100, only when their stake reached 1%, they are declaring it. At that point, you are going to buy it at a much higher price than what they have been buying it for the past how many ever years. So always make sure that you understand this. When things like these happen, the prices of that stock just skyrockets whenever these news is declared, and then you are buying it at a much higher price, which is bad for you. So always make sure, do not invest just blindly because some big investor is also investing into that particular company. Then you have active investors. These are basically people who are cherry picking particular stocks based upon their own research and fundamental analysis, and they think that this stock has value, so they buy it. After that, you have short-term investors, also called as traders. The whole ideology behind a trader is to buy a stock based on certain momentum or certain price action of that stock. They look at particular patterns with the help of technical analysis, and then they decide what stock they need to buy and when do they need to buy it. As soon as they buy the stock, they are always looking for when to exit. That's how that works. They are not really concerned about what is the latest product that the company has released. They don't care about the financials of the company. They just care about the price movement of that company, right? If it is going up, if it is going down, that's all that they really care about. So make sure that you understand this very simple thing. Now let's take a look at the different type of charts you can have whenever you're viewing a particular stock. So this in front of me is the Nifty index, and this is a candlestick pattern. The time frame set to be 1 day, and you can also choose various different time frames, and you can view how is the particular stock performing in that time frame. You can have different views, you can have different displays as well. So I can change it to bar, and this is how bar will look like. I can change it to, let's say, a line pattern. So this will basically give me the closing rate or the closing points for the Nifty index on every single day. And then it just creates a line chart in front of me. So as you can see, this is how the line chart is looking. This is what today's graph is looking, which is down by about 1%, as you can see. So whenever you have a stock, it will be at a certain price when the market is opening. It will have some movement throughout the day, and then at 3:30 it will close with a closing price. And we can see that very well with the help of this bar chart. So as you can see, what is basically happening on the 17th of January 2022 is that the price opened at about 18,237, and there was some fluctuations throughout the day. It closed at 18,308 basically, right? So that is basically the opening and closing price of the Nifty index. After that, you have this line right here. Now this line is showing you the highest and the lowest price of Nifty on that day. Basically the fluctuations that happened throughout the day. This is the lowest point of Nifty on that day, about 18,228, and the highest point was at about 18,321. So that's basically what you can look over here. There is a much better way to view all this, and that is with the help of a candlestick pattern right here, as you can see. So this is much better. It is telling you a lot more about where the market headed on that particular day. Every single candle that you can see has two things. First of all, it has the body. So this is the basic body of that candlestick, and then it also has the wicks. Then it has the upper wick and it has the lower wick, and you can basically see the lowest price for that particular day of that stock or the index, and you can also see the highest price of that stock on that particular day itself. So that is basically the whole idea. You can view this with the help of candlestick patterns. Now one very interesting thing you will notice is that the price opened for Nifty at about 18,234 on 17, and it closed at 18,308, and then we had this red candle today. In this, that basically just tells me that the opening price for 18th of January was 18,114. So that is a gap down opening, because the previous close was 18,309 and the today's open for the market was 18,112. So this is going to be a gap down opening. You can also see a gap up opening right here in this case from 11th to 12. So you can see that for Nifty, it closed at 18,056 and then it opened again at 18,170. That was a gap up opening for this particular index. You can do the same thing with the help of stocks as well. Now, when you're doing technical analysis, your basic work is to find out patterns, and then based on certain patterns of these candlesticks, you put your bets. There are also other things that are called as technical indicators that I will be talking about in some time. One thing to understand is the concept of support and resistance. So support is basically a zone in the price chart of a stock or any other equity or anything, that depicts that whenever the price goes to that zone, it is likely to bounce back, because that's a good zone defined by other investors. Maybe it's a good buying opportunity at that price because that is a fair valuation of that company and that stock. Then you have the resistance levels. Resistance levels are zones in the price chart where whenever the stock hits that zone, it automatically retraces back, right? There is a selling in that particular zone. So this is basically what happens. And when the stock goes above that zone of resistance, it's called as a breakout towards the upper end. Basically, if you can find 2 to 3 different places at which the price has gone down and then again gotten up, that can be a zone of support. And then whenever you find 2 to 3 places at which whenever the price goes up and it goes down, that's a part of resistance. So that's what you can do. You can create these zones, and then depending on that, you can understand where is the stock or the market headed. So that's what you can understand from that. Then they have these technical indicators. There is something called as daily moving averages, which basically just calculates the average price of a stock which is moving daily. What that means is that, let's say the current date is 18th of January, and I am not counting weekends, so don't think about that. I am taking a look at the 5 DMA, the 5-day daily moving averages. So that is going to be 18, 17, 16, 15 and 14. These 5 days, it will calculate the average price of a stock and it will give me a number. Now when I go to 19th and I then calculate the 5-day moving averages, it will give me the dates from 15th till 19th, and it will then calculate the value of the stock and give me the average value. That is going to be the moving averages. It is moving when you are going ahead or when you are going before. Then you also have something called as exponential moving averages, in which you take into account the recent price action of the stock more than the previous price action of the stock. Let's say you're looking at 200-day exponential moving average. So the recent days is going to have much more impact on the average value than the previous days. So that's basically how you should think about it. A lot of traders think that exponential moving averages is a much better indicator of where the stock is moving. So I'll just show you an example of that. What we will do is we'll just basically search for moving averages, and I can go for a period of, let's say, 100 days, or let's just go with 50 for now. This is the 50 daily moving average, and I can then click on done. And as you can see, this is going to give me the average value of the Nifty index for the 50 daily moving averages. You can get a brief idea of where the market is headed with the help of this. You can also create more moving averages if you want to. So I can maybe create a moving average of, let's say, 15 days, right? And I can then change the color. I can make it something like, let's just go with black. Now, because the 50-day moving average is going to be for a shorter duration, it's going to be much more in sync with the price of the Nifty index. Now, the basic idea is to look at the current price of that stock and the moving average of that particular day, and that will give you an idea of if the stock is overvalued or if it is undervalued. Also, there is a very simple system that you can create to trade, and that is by having 2 different daily moving averages and then plotting them on the same chart, and then you can check for when are they converging. Like for example, as you can see, the 15-day moving average is converging with the 50-day moving average at this point, and it is going above it, and then it goes below it on this point. So you can create a strategy that basically says that you buy when this thing happens, when the fewer day average goes above the larger day average, and when it again converges with it, that is when you sell it. Just a very simple strategy that you can try and see what happens. So this is one system that you can create as a trader. There are many more systems that you can create. You can look at various different patterns for the candlesticks, and you can predict what is going to happen next. Also, always keep one thing in mind. These are all probabilities. These are all possibilities. These things can happen. It's not guaranteed. And that is the most important thing to keep in mind. If I talk about what are the different patterns, you need to read more about that. I'll put some links in the descriptions to learn about all of these things. But you have something called as Marubozu candlestick pattern, then you have doji, you have shooting star, you have a hammer, you have paper umbrella, you have a hanging man, and you have many others. Then you also have multiple candlestick patterns. So by taking into account 2 or 3 candlesticks, you can understand where is the market headed over the period. So you have something called as an engulfing, You also have a piercing, and you have some other methods as well. I will leave some really interesting links in the description to learn about all of these things. I think this is really interesting and you should totally take a look at this field right here. You also have something called as relative strength index. So I'll just search for that right now, or I can just search for RSI and I can enable it right here. So basically what happens is that RSI is comparing the price of the stock today with the previous performance of this stock itself. And it is going to give me a number between 100 and 0. And the basic idea is whenever the RSI goes above 70, that can be an indicator that this price is overvalued, and when it goes below 30, that can be a time to buy. Now there is a lot more that you can learn about technical analysis, so do your own research and then get into this field. Also, just keep this one thing in mind: making a lot of money as a trader is possible, but it's not probable, right? So it's a lot harder for you to make money as a trader because you're putting in a lot of time and you just have a lot of unknowns. Versus if you hold on a stock for a long duration and you know the company is good, then in the long term it is going to perform a lot better. That's just what my personal thinking is, and that's why I don't really believe in trading. I just invest and I forget about it. So that's what you should think about. All right, now that is the basics of technical analysis. Then we go on to look at fundamental analysis. So this is what you would do if you are a long-term investor, or if you just want to invest and then you want to sell in about 1 year or maybe even 6, 7, 8 months. So that's what you would do. The basic idea behind fundamental analysis is that you review the company, you take a look at the financials of the company, and then you make your own guess as to how this company will perform over the long term. Okay, maybe there are some fluctuations in the short term, but you really care about the long-term performance of this company. So that is what you will find out when you will look at the annual reports of the company. Basically, for any publicly listed company, it is compulsory to put out their annual report for the investors. So you can go on to Google and you can search for the annual report of any company that you want to. For example, I will look at the annual report of Infosys for 2020 and I can get that right here in front of me. This is the 320 page PDF. You don't have to read all of it. You just have to read the parts in which they are talking about their financials and the place in which they are headed in the future. So basically there are two things. One is the qualitative analysis, then you have the quantitative analysis. Qualitative is all about looking at where the vision is for the company, what product segments do they have, what is their advantage in this particular sector, what is it that the competition is doing, and that is basically what you should keep in mind. So you can go down, this is for example the Infosys annual report of 2020, and you can just read this and understand what are they trying to do. You can also learn about the competitive advantage of this company, you can learn about this whole sector in general, and you can also learn about what is it that the competition is doing. So once you take a look at the qualitative analysis, the next thing is going to be the quantitative analysis. This is the more financial reports that you need to read to understand about the health of this business itself. So take a look at this consolidated financial statement right here, and you can look at each of these things separately. First of all is the balance sheet, then you have the profit and loss of this company, and then you also have the cash flows of this company. So this is the profit and loss statement for Infosys for the year of 2020-21. So as you can see, the revenue from operations was actually 1 lakh crores. This is in crores rupees, and you can compare that with the last year as well. Then you can also see their net income. You can also see the expenses that they had to go through. They're also breaking down what are the exact expenses that they have as a company. Then you can also take a look at the operational profitability, which is also called as profit before the tax. That is just going to be the revenue minus the expenses. That is going to give you the profit before tax. After that, you have the tax expenses. So whatever taxes they have to pay. After you take all of these things away, basically revenue minus expenses minus taxes, then you are left with the profit. And that is called as profit after tax. So this is the cash flow statement of Infosys. You can see first of all the operating activities and the cash flow from that. That is basically all the business activities carried in that year and what was the cash flow generated from that. You can see that right here, and you can also compare it with the last year. Then you can take a look at the cash flows from investing activities. That is basically what all they invested in properties, plants, equipments, as you can see, right? Dividend received, deposits. Then at the last, you will also see cash flows from financing activities. This is basically all the liabilities that they have right? So as you can see, payment of lease liabilities, payment of dividends, whatever things that they have to pay off. After that, you can also take a look at the balance sheet of Infosys. So you can take a look at the assets and the liabilities with the help of this sheet. Now assets can again be categorized between non-current and current assets. Similar is the case with liabilities. So for example, if they had to pay off a loan that they have taken for, let's say, 5 years, that is going to be a non-current liability because they will be paying it over 5 years, right? So they don't have to pay it in this year itself, and that is why it is a non-current liability. Then you have a current liability. For example, something that they had to pay off in this year itself, that was the liability for them for this year. Similar is the case with assets. You have non-current and then you have current assets right here, as you can see, right? So for example, property, right of use assets, capital work in progress. Then you can also look at other things like you have financial assets, whatever investments they have done, whatever loans people have taken from them. Now your work as an investor is to take a look at all of these values and then create indicators from them, create ratios from them. For example, you have something called as gross profitability margin for that particular business in that year. Then you also have profitability ratios, which include EBITDA margins. Then you have PAT margins, which is profit before tax margins. Then you have return on equity margins. This is going to tell you how well are they performing in terms of profitability. Then we have leverage ratios. You always want to make sure that either the company has no debt, which is amazing, or they have debt, but they are capable of paying the debt and they will not be insolvent, right? Evergrande had kya hua? Evergrande was defaulted because they were not able to repay the loan that they had taken. So if you take a look at this, they have interest coverage ratio, and they also have debt to equity ratio. So make sure that you learn about what these things are and how they can be calculated. Then you have valuation ratios to understand how well is this stocks valued in this particular market. So you have something called as price to sales ratio. Then you have price to book value ratio. Then you have price to earnings ratio. So you'll have to first of all calculate the earnings per share, right? So total earnings that the company had divided by the total number of shares that are outstanding in the market. With that, you can calculate this price and then you can divide it with the price of that particular stock right now. And then you will get the price to earnings ratio. This is probably the most important, the most famously talked about ratio out there for any other stock. Then if you want to value a particular company, they have various different methods for doing that. There is something called as discounted cash flows, in which you look at the current cash flow, then you predict the future cash flows, and then you also look at the risk involved in this particular business, right? And using all of these, you come at a particular valuation for this company. And then you divide that by the total number of shares and you get to have the actual intrinsic value of this stock. And if the stock is trading below the intrinsic value, that is great. You can then buy it. If it is above that, then you might want to wait for it. So that's basically what this means. With the help of fundamental analysis, you can find out the actual value of this stock and then you can stay invested for the long term. So that was the whole idea. I hope you are able to understand. If you have any questions about the same, let me know in the comment section. I'll just show you a quick review of how can you find all of these information very quickly, because again, this might be very much jargony and you might not be able to understand everything over here. You can simply just go to something called as ticker tape and you can just search for any company. Let's just search for Wipro and I can get all the financials of Wipro right here, right? So I can look at the income of Wipro. So this will give me all of the different ratios, the net income, the EPS, the DPS, which is basically earnings per share, and debt per share. And then you can compare how it is doing in the past few years. You can view the balance sheet and you can see all of the different values. You can also take a look at the cash flows. You can also take a look at the overview of this complete of this stock. You can also view other metrics like you have P ratio, PB ratio, dividend yield, sector P. So basically what happens is that every other sector will have a different P. So for example, let's say there is a P of 20. Now, is it good? Is it bad? You don't really know about that. But let's say that this sector of this company has a PE of 25. Then in that case, the PE is lower of this company, which means that this can be a good buying opportunity for you. Always compare it with the sector PE and then come to this conclusion of if it is a good thing or a bad thing. So keep this thing in mind. You can take a look at the sector P by B ratio, which is just price to book value. So basically for the book value, this is just going to be the total assets of this company. subtracting that from the total liabilities of this company. Then you get to the total book value of this company, and then you divide it with the price of the stock. So that's basically how this will work, right? So that is the basic overview. Take a look at ticker tape. You can take a look at screener as well, and you can start reviewing all of these companies and seeing if this works for you or not, right? You can view all of these things. ROE, which is basically return on equity. You have book value. You have stock PE ratio, ROCE, which is return on capital employed. So learn about all of these things and then decide if you want to invest in a particular company or not. So that should do it for this video. I hope you got to learn something from this. I have been recording this video from the past 3 hours now, but I hope that this one session has been helpful. Please let me know in the comment section what questions you have, what doubts you have. I might have made some mistakes in this video, so I'm really sorry for that if I have done that. But I just wanted to share my insights, whatever I have learned over the past couple of years about the stock market. All right. Thank you so much. Now, one question you might be thinking is, how do you learn about all of these stocks, which stock to pick, which stock not to pick? You can take a look at news of these companies, and then you can decide if this is a good stock to invest or not. So you can go to maybe there's something called as FinShots, and you can get all of the news in your inbox. That's what I use, and this is something that you can also try out. You can also take a look at Moneycontrol. So basically, Moneycontrol is a great place for you to get news about the stock market as well, right? So as you can see, this is the Corona news. You can go to the markets and you can see how are the markets performing. So this is another great way for you to learn about how the market is behaving. But always make sure that you do proper analysis before investing somewhere. Now, I have listed some amazing books that you must be reading if you are into investing, because investing is a lot more about psychology than anything else, right? Yes, it's about the numbers, but it's also about the psychology of people and what do people think about valuations or where the market is going. I'll give you a very interesting example right now, right? So as you can see, this in front of me is the chart of Nifty back on January 2021. Now, that was the time when the budget 2021 was about to be introduced on the 1st of February. And people were speculating what will happen for that. And whenever something like this happens, the market always panics, right? So that was the first experience I had of the psychology people have about investing, right? So as you can see, the market was about 14,362. Then for the 3 consecutive weeks, it dropped. And it dropped all the way from 14,364 all the way down to 13,633, right? So this was a good buying opportunity. And right after the budget was introduced, there wasn't any major changes, which was good news for the market. The market went back up and it even got to higher highs. As you can see, right? It achieved even bigger all-time highs in the future. So always make sure that you understand that it's a lot more about psychology than anything else when you're talking about the stock market. But that was all I had to share with you. Do take a look at the resources that I have pinned in the comment section as well as in the description. Also take a look at Groww if you want to start investing in mutual funds, in stocks, in various other assets. And yeah, that's it. You can also take a look at the Invest Kar Befikar channel, in which we'll be going into much more depth about everything, about fundamental analysis, about technical analysis, about investing in general. Okay, so do take a look at that. I will see you all in the next video. Make sure that you share this video with your friends as well. It would be amazing if you can share it with people. And yeah, hit the like button, share it on social media. You can tag me there on Twitter, LinkedIn, as well as Instagram at Ishan Sharma since 90. I will see you in the next video. Bye-bye.